Hey everybody, welcome back and thanks for joining us. This is Stuart Smith from smallcapvoice.com, and I'm joined once again by the dream team at Supermassive Media. That's Kevin Gray, Demetrius Thurston, and J Rab, DJ J Rab. I always want to say that, but I never do. The guy that was born with a DJ's name, J Rab. Anyways, today we're talking about a different type of market. We're all used to hearing the bear market, the bull market, the bear market being 20% off recent highs, the bull market being 20% up off of recent highs. But today we're going to talk about a kangaroo market, which if you look year to date, it's kind of hard to see that. To be honest with you, I went through a bunch of charts of some serious blue chips, and they do look very, very bullish. However, if you look at a 60 or 90-day chart, you start to see that kangaroo chart materialize. Think about what a kangaroo does. It hops up and down. It seems to be random. It doesn't seem to have any driving factors. Of course, an actual kangaroo does: food, sleep, whatever, water. But this market that we're seeing, a kangaroo market, why they say that is it seems to not respond to the outward stimuli exactly the way you would think it would, such as job numbers soaring, market goes down, these types of things. It's counterintuitive to some degree, but not always. Again, it lacks a pattern. That's what a kangaroo market is. Kevin Gray, let's start with you. What are your thoughts? Are we in a kangaroo market? What are you seeing from your end?
I would say yes. And the number one thing is, from a marketing perspective, kangaroo market is a big indicator for us, because we obviously in the marketing space, we don't try to move a stock price. We don't try to move anything like that. We just try to get the information to the viewer, to the audience. But we can correlate our movement with positive action in terms of volume and how many people are watching the stock. And so in this market for the past 3 to 6 months, it's been relatively stagnant. You'll get these little bursts of volume and then they'll just fizzle out. And you can kind of do a little bit of research and figure out what's going on. I'm probably going to be a little speculative here, and I'm going to say I think that this is a big indicator that the average Joe retailer is just tapped out. They're not buying stocks right now, or if they are, they're flipping very, very, very small positions for very, very short gains. I think what we're seeing here is the market makers, the institutions, pulling long and short plays on their own positions just to kind of keep money coming in and out during a really dark time in the market. I mean, we see blue chips, like you were saying, they're not doing too bad, but you look in the small cap space, you look in these penny stocks, it's pretty abysmal for some of these. You see companies that are risking delisting all the time. You see companies that are risking compliance issues because of this. It's unfortunate, but it's because of these big market makers, these big institutions that are able to play with these positions. We talked about shorts last week and naked shorting. It's kind of the same thing. It's that market manipulation that's kind of keeping things flatlining.
Yeah, I think the kangaroo market can lend itself to that sort of behavior from market makers. Now, Demetrius, this may not be what you prepared to talk about, but I know you like to work in options and calls and puts. And in a kangaroo market, that's got to be a little bit more difficult because you're not seeing things react the way you think they would. CPI numbers come out, and typically, yes, the market has reacted negatively to negative numbers, but when we're expecting somewhat of a rally based on the fact that numbers are up lately since November, we're not seeing that materialize. What are your thoughts on that, Demetrius?
It goes really hand in hand with what Kevin was saying about market makers kind of just trying to spin any profits they can right now. In 2020, it was like just pure rally. And then in 2022, I mean, most growth stocks are down anywhere from 60% to like 85%, especially a lot of the blue chip ones. And so at this point, it was pretty clear you could do calls in 2020 and generally got a call on anything. It was perfect. Puts all throughout 2022. Now, nobody really knows what to do, and everything is a lot unsafer, it feels like. The CPI came out, want to say last week, and it was above expectations. It was either CPI or jobs data. It was above expectations in a bad way. and the market rallied off of it for some reason.
Yeah, CPI was this week, jobs was last week, but I know what you're talking about. Yeah. And what do you think, Jay? What's your take?
Ultimately, I say if we're in a genuine kangaroo market, is we've always had that age-old adage that it's buy low, sell high. And so if you're dealing with a kangaroo market, when it goes down, you as a retail investor, you buy into that, and then you're just expecting it to go up at random. You just need to be prepared to flip that and then kind of rinse and repeat.
Yeah, but the takeaway I'm getting from Kevin and Demetrius is, though, that some of the stocks that are more affordable to do that with, buy low, sell high, you're not going to do that with an Amazon. You're not going to do that with an Nvidia at $225 a share unless you're, a baller. And in that case, then yeah, go for it, because those are, the 90 days really are showing these dips followed by a nice increase after that. But I've always, being the elder statesman here, once again, I'll put out there, I've always seen the small caps pull us out of these recessions. So bottom line is, if the small caps are showing more volatility, facing more downward pressure, the capital markets, such as the financing for these stocks, seems to be drying up as well. Boy, we've got kind of a perfect storm here on the cheaper stocks that you can, Jay, to your point, buy low and sell high on. Anybody want to jump in on that?
I think that there is an advantage to buying low, selling high right now. There is definitely a risk that you might buy in and it might go down a little bit more. So if you're looking at more long-term investing than just trading, dollar cost averaging is kind of your best friend right now, because the market could go from how it is right now to another bull rally. It could then kind of just plummet. Inflation can get out of control. The Fed might not be able to handle it. Either way, if you're looking for the safest route, what I've found is dollar cost averaging.
I think that's a very fair point, but it makes me want to say this is a great time to be looking at dividend plays and other types of investments as well. I don't have time to sit there and watch tickers all day. I am go all day long, kind of getting stuff done. And so I can't day trade. I can't even swing trade most of the time. I'm lucky if I have a chance to open up my portfolio. And so what I look for in these times are your dividend plays. What are going to pay me just for sitting and holding this, regardless of what that price is? Target is a phenomenal dividend stock. TGT, I love Lowe's. Lowe's is actually doing pretty good today too. It's those kind of plays that's what I look for in these types of markets. Yeah, the small caps are going to be what brings us out. Let's be honest here. I'm in this to make money. And so when I'm in this to make money, I'm going to do what's safest for my portfolio. I'm going to hedge my bets, and I'm going to look for something that's going to make me money on the side while I sleep. So that's my take on it.
Well, my take on it is you're incredibly busy, and Demetrius needs to find more work so that he doesn't have as much time to day trade as he does. That might be our key takeaway for today. Well, I want to thank the guys at Supermassive for joining me today here at smallcapvoice.com. Hey, tune in every week and give us your questions, your comments. We'd love to get your feedback. Thanks for joining us today.